Joining me right now is the White House Council of Economic Advisors Chairman Kevin Hassett. Kevin, it's good to see you this morning. Thanks so much for joining us.
Great to be here.
Do you agree that the Fed is out of control, Kevin?
You know, I think that President Trump is a very authentic individual. He says what he thinks, and I think that that's why Americans like having him in the White House. You know, I think all of us at the White House respect the independence of the Fed. That's why we appointed such great people over there, like Jay Powell, and I wouldn't want to advise them about what they should do with interest rate policy. I can say that looking at the movements in markets, as everybody knows, they're concerned about a number of things. One of them is the path of interest rates, and another is the election that's upcoming and what it means for economic policy. You know, we've made an enormous amount of ground up getting the economy back on track with President Trump's policies, and of course the political reversal might, threaten to reverse those policies. And if I were in markets, I'd be nervous about that as well.
Yeah, I understand what you're saying. So we do have a very good backdrop, Kevin. You and your colleagues with the tax cut plan and the rollback in regulation certainly moved the needle. But how significant is the move in rates in terms of potentially cutting into that growth, Kevin? Because you know the narrative out there that sure, we've got a 3% grower this year, or 3% plus. We just saw 4%, obviously. But into 19 and 20, things slow down. How significant will higher rates cut into the growth story, Kevin?
Well, I thought that you guys in your conversation right before I came on, as always, Maria, you kind of nailed it. And again, I'm not trying to invade the Fed's turf at all, but in our models, our big macro models that say that we get 3% growth out of the tax cuts, there's also a path of interest rates that comes from that. And the path of interest rates that comes from that is a little bit higher than the path of interest rates over the last few years, and very consistent with the Fed's forward guidance and even what you see in the CBO 10-year outlook. And so, of course, as the economy grows faster, then interest rates tend to drift up. That's how economic models work.
Right, understood. But I mean, there's a narrative out there, as you know, like, for example, Robert Kaplan, the president of the Dallas Fed, told me that, yeah, we're going to see 3% plus growth this year, but by the time you get into 2020, it's going to go all the way down to 1.9%. Do you see that? What's the vision going out a couple of years?
You know, I could think of a scenario where something like that might happen, but it would come from outside the U.S. I think that looking at the U.S. alone, what we've got right now is a capital spending boom, which means that there are new factories, new machines, new workers being hired, and so on. And that's what's happening. It's driving GDP right now. In the second half of this year and next year, all of those new factories are going to make output. So that means output has to go up because we got all these machines making new output. And so you get a second bite at the apple. And so I think that the momentum we're seeing right now, if it were just consumption, then we'd be thinking, oh, geez, well, it's a consumption binge and people are going to have to, go on a diet soon. But it's not that. It's capital spending. It's new factories. And the new factories, once they plug them in and turn them on, you get more output. And so it's really about, as safe a bet as you could have that this momentum will continue.
So you would think then that the rollback in regs and the tax cuts have a runway in terms of their impact on things like businesses spending money, releasing the animal spirits.
You got it exactly right.
Yeah.
And I would never look at the market and pretend I'm smarter than the market. I'm an old Chicago style guy that thinks the market's very, very smart. But I could just say this, that if you look ahead and then some people will think, oh, geez, if there are all these socialists in the Democratic Party that want to pursue socialist policies, that would be really bad for markets. And then if you give that a 20% chance of happening or 30% chance of happening, then that affects the price right now, right? And I think that one thing that I can see is I see a lot of discussion about that stuff, but not a lot of discussion about the upside of President Trump getting more power so that we can pursue taxes 2.0, a more aggressive deregulatory agenda, and so on. And I can tell you, or an infrastructure plan that the president's talked about all the way back to the campaign. And so we've got a lot of great ideas to make the growth that you're seeing right now even accelerate. And I think that if the election goes the president's way, then it'll be a lot easier to pass those policies.
Right, I understand. But what if it doesn't, Kevin? I mean, what happens then if the Democrats do, in fact, flip the House, hold the majority in the House of Representatives? Does the president's agenda come to a halt?
I was up in New York a couple times in the last week talking to investors, and your question right there is a question that was on everybody's minds. And I can tell you that the good news is that our dereg agenda can continue because it's basically something that's done at the cabinet agency level, and the tax cuts are not going to be reversed. There's no way in a zillion years President Trump is going to sign a bill that turns back the tax cuts. And so even if there were something that was going to happen in November, it's not really going to have a big effect on our major accomplishments. So you'd have to change the White House to do
that. All right. Well, that's good. Markets should see that and probably stabilize. What about the supply chains, Kevin? I got to get your take on the impact of tariffs, because the president is now reportedly going to be meeting with Chinese leader Xi Jinping. There are escalating trade tensions. The Journal this morning is reporting that the talks will take place next month at the G7, the G20 leaders summit in Buenos Aires. So this could go on for a long time. I mean, what's Plan B in terms of these tariffs impacting the economy negatively?
You know, those talks are close to being a closed deal, and maybe overnight, you know, since I was last briefed on it, it was closed. Decided that meeting was going to happen, but it's very close to happening, if not happening. So, you know, I can almost confirm that story. And the one thing I can say, watching the president operate since I've been here since a year ago, June, is that when you want things to move and you really want them to move fast, then you involve the president. He's a person who makes quick decisions, figures things out, knows how to close a deal. He wrote the art of the deal. And for me, just as an economist, I'm not a negotiator. I've thought from the beginning that we need the president and President Xi, who, you know, they're close friends. We need those two guys to sit down and work it out. And the fact that it's looking like they're going to sit down, you know, I think that it's very promising, and that it's not a sign that we've got years and years of talking to do, because President Trump doesn't do that. He wrote the art of the deal. He wants to make deals, and I think that the fact that they're talking suggests that, you know, there should be a great deal of hope that we can resolve our dispute sometime soon.
You think a resolution could happen sooner rather than later? Because there's some people saying that this could go on years. You're dealing with a dictator for life.
I mean, you put President Trump in a room, he's a great negotiator. You know, I would not underestimate how fast this thing could go.
So how worried are you about interest rates? That was the worry this week, you know, higher rates cutting into growth, and that's why you're seeing the shift in allocation. 3% on the 10-year obviously is still very low, but the speed with which this moved is unnerving.
Well, I think, again, you guys talked about it, and I don't want to criticize the Fed, and we're talking even about rates that aren't necessarily directly controlled by the Fed. The bottom line is, if you have stronger growth, stronger productivity growth, then that means that the equilibrium interest rate goes up. And all our macro models say that. And then the question is the interest rate going up faster than the models would predict? And the answer is no, that they're moving about in line with each other, which means, going back to one of your earlier guests, I couldn't tell because I didn't see it on the screen, said, you know, I want the growth. You should want the growth.
Right.
Because you get that growth. You know, there are going to be times where people are a little nervous about the interest rates that go along with it. But it looks like the normal economics, macroeconomics of the U.S. economy is working, and that we're getting growth, and we're getting higher growth, and that, you know, the rates are moving along with that.
So you're looking for a 3% grower for 2018 for the year?
I think it'll be above that.
And
yeah.
above 3%? What about 2019?
Yeah, we've got it about the same in 2019 as 2018, and it's based on a lot of modeling that says all those new factories are going to start producing output, and so therefore output has to go up. And so we think we're going to start out with two very solid years north of 3.